The first thing that you probably ask a mortgage banker when you're trying to get a loan is what's your rate? The truth is, there's no such thing as what is your rate when you're talking to a bank or a lender when you're trying to get a home loan. In reality, it's the rate that you're going to qualify for. So what I'm going to do today is I'm going to walk you guys through a couple different examples of how interest rates work so that when you guys are talking to a mortgage banker the next time, you guys are more educated on the process and how this stuff works on the back end so that you know how to shop around and get the best deal possible. Okay, so check this out. All of this information here on my screen, I made all of this stuff up with respect to like the points and the interest rates and all that kind of stuff. Nothing here is real. It's all fake. But the premise of what I'm about to show you is all accurate. So here's the way that it works. On my screen here, what you're going to see is the interest rates. You're going to see the points, credit score, loan to value, property type, occupancy type, mortgage type. Every day in the morning, the bank will send out to its bankers this thing right here. It is called a rate sheet. What the rate sheet is that it tells the banker what the interest rates that the bank is offering on that day. And usually, there's always a spread of interest rates. So in this case here, in the fake example that I'm going to show you guys, it's between 5.5% and 7%. This column over here, it's showing you what the bank is going to charge you for each of these interest rates. So if you wanted a 5.5% interest rate, you're going to be charged 1.5 points to get that interest rate. What does points mean? Points basically means the percentage of the loan amount. So in this example here, 5.5%, if let's say you had a $100,000 loan, 1.5 points is 1.5%. So 1.5% of $100,000 is $1,500. So that's what they would charge you to get this interest rate. On the flip side, you see this here where it says a credit. The points is what they would charge you. The credit is the money that they would give you as like a discount. So 1.5% credit is they would give you a credit for $1,500. This here is what's called the 0-point rate. This means that they're not going to charge you anything or give you a credit. It's called the 0-point rate. All right, so what I'm going to do is I'm going to walk you through a couple different examples of how interest rates work with a fake borrower that has a specific credit score, loan to value, property type, occupancy type, mortgage type, and I'll show you what this person's interest rate is going to be. So we're going to use a fake loan amount, $100,000. Now, the closing costs that you guys are going to get when you're shopping around for a mortgage, they're pretty standard, right? So the closing costs are different than the points. The closing costs are like, your appraisal, your title, the processing fee that the bank is going to charge you. They have nothing to do with the points themselves. So just keep in mind that there's always going to be some closing costs. They have nothing to do with the points. So here's an example that we're gonna look at. This guy has a credit score of 720. They have a loan to value of 65%. He lives in a condo. It's a primary home, and it's a rate and term. Rate and term basically means that you're not taking any cash out of the equity of the house. You're just refinancing whatever you owe on the loan. So let's see what this guy is going to pay for a mortgage. So if he has a 720 credit score, the bank is going to charge him a quarter point. Loan to value, 65%, quarter point. There it is right there. He lives in a condo, so the bank is going to charge him 1 point because he lives in a condo. Primary home, no points. Rate and term, no points. So if we add up all of these numbers here, that totals 1.5 points. All right. So now we're going to take 1.5 points and we're going to go back to our original rate sheet. So if you're looking at what the bank is going to charge this guy, you have to take the 1.5 and you have to add it to this column, all the numbers on this column here, so that you know what each interest rate is going to cost, right? So if this guy wanted a 5.5% interest rate, 1.5 plus the 1.5 they're going to charge him, 5.5% is going to cost him 3 points. 3 points on a $100,000 loan, $3,000. So in this example, what would the 0-point rate be is probably what you're thinking. The 0-point rate, which they wouldn't charge you anything, 1.5, where would that land? It'd be right here, right? So the negative 1.5 credit would be eaten up by the 1.5 points that they're going to charge him because of his profile. So 7% would be this guy's 0-point rate. Okay, let's walk through another example. Again, $100,000 loan amount, closing costs are going to be $2,000. All right, so this borrower has a credit score of 780, loan to value of 60%, single family home, primary residence, and they're going to take some cash out of the equity of their house, meaning they're going to pay off some debt, or they just want some money for home renovations or whatever they're going to do with the money. So let's figure out what the bank is going to charge him for this particular, with this borrower. 780 credit score, no charge. Loan to value, 60%, no charge. Lives in a single family home, no charge. Primary residence, no charge. He's going to take cash out of the equity of his house, 0.5 point. So the total points is 0.5, right? So again, we take the 0.5 and we're going to go back to this column over here, and we're going to add 0.5 to all of these numbers, all of them, so that you know that whatever interest rate that you would want, you're going to add this number with the 0.5. So where would the 0-point rate be for this particular borrower? The 0-point rate would be at 6.5%, right here. Negative credit of 0.5, it would be eaten up by the 0.5, so that means 6.5% would be this borrower's 0-point rate. So when you guys are out shopping for a home mortgage, right? So rather than asking, what is your rate? First thing that you should do is you got to know that they're going to ask you all of these questions. What's your credit score? What's your loan to value? Is it a single family home? Is it a condo? Primary residence? Do you live there? Is it a rental house? They're going to ask you all these questions. Is it rate and term? Is it a cash out? They're going to ask you all these questions right off the bat. And then they're going to tell you what the interest rate is going to be. And if you want to be an educated borrower, what you should do is, when you want to shop around from lender to lender, is you should ask them the questions of, how much are you charging me for my credit score? How much are you charging me for my loan to value? What is the interest rate before any of these adjustments? What is the interest rate, right? The fact that it's a primary home, the fact that you're taking cash out. So ask them all of these different things, write them down, so that you guys can be more educated buyers and you guys can sound like you know what you're talking about. So when you're talking to a banker, they're like, okay, this borrower knows what they're talking about, so I got to be open, honest, and transparent with them. I appreciate you guys watching the video. Hope you got some value out of it. Do me a favor, hit that subscribe button, drop me a like. If you got any questions, or you want to ask me a question about this particular example that I gave you guys, drop a note in the comments there, and I'll see you guys in the next video.